Assets equal equity plus liability is an accounting equation that comes from statement of financial position. It will show the position of assets and equity, also liability, at a certain period of a business. Assets are property that owned and controlled by a business, whereas equity is any balance that the owner will get after deducting all the business assets with its liabilities. Meanwhile, liabilities is obligation of the business that need to be paid. Any business transaction will be affected by this accounting equation, and it will show what is the current position of asset, equity, and liability. The following example will show how the accounting equation will affect the business transaction and how its position of assets, liabilities, and equity after each of the following transactions occurred. Day 1. Proprietor opens a new business account with 10,000 cash. Since the proprietor invests $10,000 for the business will increase by 10,000 in bank and also increase 10,000 in capital in equity side. The business will show the financial position as assets by 10,000 and liability plus equity with the same amount of 10,000. Day 2. Purchases 200 books at $20 each for cash. Purchases is classified as expenditure and it will decrease equity at equity side. It will decrease by 4,000 for purchasing 200 books at $20 each. This purchases is made on cash, so at the asset side the bank will decrease by 4,000 also. As the balance to date, the asset is 6,000, which is decreased by 4,000, and at liability plus equity side the balance also 6,000, which is same as the asset side. Now day 3. Purchase 300 books at $15 each on 15 days credit. So the buyer agreed to 14 days in which to pay, meaning that the business will pay the book within 14 days. As for accounting equation, these purchases also will decrease the equity size by 4,500, which is 300 books multiplied with $15 each. And since these purchases was made on credit, there is an increase in liability side as trade payable with the same amount of 4,500. So for the balance to date, we can see that the asset sides remain the same. They remain the previous amount of 6,000, whereas for liability and equity side, For the equity, the amount decreased to 1,500 and liability is increased in 4,500. So the total amount for liability and equity side is 6,000, which is similar as asset part. Day 4. Sales all inventory held for $12,000 cash. Since sales is revenue, so it will increase the equity side by 12,000 for sales. And a business will receive bank cash amount by 12,000 also. So for the financial position to date, the asset will show the amount of 18,000 and liability plus equity now it increased to 18,000 also, which is the increase in equity side to 13,500. So we can see that this equation is correct by equaling asset with the liability plus equity. Day 5. Pays $150 cash to deliver inventory to customer. So this is expenditure for delivering goods to customer, and it can classify under carriage outward. So the carriage outward will decrease the equity side by $150, and the payment was made by cash. So the bank also decreased by $150. As a result of that, the balance for the asset side now decreased to 17,850, and also for the liability and equity side is 17,850. Finally, day 5, day 6. Proprietor withdraws $500 cash for personal use. So for the business cash, which is $500, is decreased at asset side, and this is considered as drawing. So the drawing will decrease equity side also with the same amount, 500. As a result of that, the asset side now becomes 17,350, and for the liability and equity side is also the same, which is 17,350, which is the decrease in the equity side by to 12,850,000. So for the accounting equation, we can see that the assets always equals with the liability plus equity, which is 17,350 for the assets, and for liability plus equity is 17,350. This transaction can be summarized into two statements. One is statement of profit or loss, another one is statement of financial position. Now we go to the statement of profit or loss. So for the statement of profit or loss, we begin with the sale. So for the sale of the company, the amount is 12,000, and then we less cost of sales. How to get the cost of sale? Opening inventory plus purchases minus closing inventory. Since there is no opening inventory, so we put it as 0. As purchases, we have two purchases here, 4,500. So the total purchases is 8,500, and all the purchases have been sold. So there is no closing inventory, so we put it as 0. So therefore, cost of sales is 8,500. So the gross profit the for the period is 3,500, which is the sale is 12,000, cost of sales is 8,500. Then there is expenses of carriage outward of 1,150. So the net profit for the year is 3,315. So this net profit will be carried forward to the statement of financial position. For the statement of financial position, for the asset side, there is only one asset, which is bank. The total amount of bank is 17,315. Whereas for equity, there's a movement for the equity. For the opening capital is 10,000, and the profit for the year is 3,350, and the owner take out cash from the business, which is drawing, is 500. So the closing capital for the business become 12,850. For the liabilities, there is only trade payable, so the amount of trade payable is 4,500. So we can get that total equity and equities and liability is 17,350, which is similar with the total asset, which is 17,315.